AlF 2 is a concentrated multi-cap AIF fund. The idea behind this fund is to invest both in the value and growth opportunities that come in different market cycles, as well as the fund's intention is to invest across large cap, mid and small cap. So the flexibility that this fund offers in participating both in growth and value opportunities across the three cap curves, but in a very concentrated manner, in our opinion, gives an opportunity to create meaningful alpha over a longer period of time. So in AlF 2, the investment philosophy is that we invest into two buckets of stock opportunities here. The first bucket is what we call as 20% high growth models. So what is this about? Here our intention is to invest into select say 10 to 15 stocks which have a long track of growth left in front of them. And basically here we are trying to identify companies which have a growth of around 20% over next 5-year time period. Given that Nifty's earnings growth is around 10%, if we have a bunch of stocks which are going to grow at around 20% for next 5 years, then you have a real chance of beating the market by a meaningful alpha. So that is the first bucket. And the second bucket is to invest into turnaround opportunities. See, there are two types of turnaround opportunities that we get. One is the business turnaround, wherein a special situation like a management change or an acquisition or a merger can trigger a lot of value for the investors when two entities come together, or a pure management change itself. A lot of low-hanging fruit can be addressed by the new management and can trigger value again to the investors. In addition to this, I think there are certain good businesses or the sectors like auto sector and capital goods sector, which in India go through a lot of cycles. So they throw a lot of opportunity to us in the down cycles, wherein if you take a 2-year view and invest into them and hold on to them at the right valuations, they give a meaningful alpha to the investors if you hold on to it for the 2-year time period. So these are the two buckets that we intend to invest into, and that is the philosophy of investment in the AlF 2. So the focus area for this fund is what we define as 4x4 wealth multiplier theme. The reason for identifying these themes these are fast growing segments in the overall economy. So what are these themes? I'll take you through very briefly. First theme is the financial inclusiveness theme. As a fund house, we are very positive on the retail credit penetration in India. If you look at the retail credit penetration in India, it is still far below even some of the emerging economies in the world. There is a long way to go for the retail credit penetration to happen in India. It is going to be a multi-year theme, and there is a large amount of unorganized lending still keeps happening in India. So our endeavor is to, in addition to investing in some of the private sector banks, also to identify some of this mid and small cap financial services companies which are into this retail financing, particularly to those segments of the population which don't have access to the cheaper financing as well as the flexible terms that the banks or the NBFCs can offer. That is the first theme, and here we see there are potential of companies delivering more than 25% growth for a long period to come. The second theme is the consumer discretionary theme. This is again a long-term opportunity in India. Every economy, when they've crossed $2,500 per capita income, they have seen a meaningful amount of growth happening in discretionary spending. Here again, our intention is to invest in small ticket consumer discretionary, like for example, organized retail like apparels or even grocery organized retail, or the intention is to invest into something like QSRs, travel, entertainment, even hospitality sectors, because I think as the per capita income keeps growing, an average Indian will start spending more on traveling, entertainment, education, hospitality, and these are areas where if you identify the right companies, then the potential is these companies can keep growing minimum 20% for the next 5 years. The key here is that you select the right businesses with low competition, with a defined moat, so that they can keep growing by gaining market share at the expense of unorganized players or even the weaker players in the segment that they operate in. So this is the second theme. The third theme is investing into technology space. There are two opportunities here. The technology space can be about investing into the global IT outsourcing businesses, but our focus area here for the next 1 year is going to be, can we identify opportunities in the tech platforms that are getting developed in India itself. So for example, food delivery platforms. These companies got listed at a very high valuations last year, but for the last 1 year, we have seen a meaningful correction in these companies because the kind of fund flow that the space saw led to a very high valuations last year. But now suddenly the entire momentum has shifted and fear has started coming into this space. But we feel the lower penetration of online in many of the consumer facing sectors gives a long-term growth opportunity. We will wait for the right price, and we think in the next 6 months to 1 year, you will get some of these tech platforms at a reasonable value. Investors will do well by getting into these opportunities during periods when a lot of fear is there, and just stay invested over the next, say, 4-5 year time period to reap the benefits. The fourth theme is investing into some of the companies who are into manufacturing and exporting these products outside India. Here we like sectors like specialty chemicals and pharma APIs. Why we like them? Because we feel that in these sectors, the companies there are not just offering only labor cost advantage, but also an R&D cost advantage. See, not many sectors in India has done well from an export point of view on a consistent basis. We have done so good in IT sector and pharma sector because we just didn't offer only the labor cost advantage here, but also offered the R&D advantage as well as technology capabilities. I think the other sector which is kind of getting into this high growth phase is the specialty chemical, particularly companies into CDMO and CSM sort of opportunities. We are seeing that China plus one story and Europe outsourcing story clearly playing out in some of these segments. In addition to those specialty chemicals and pharma APIs, I think there are some specific companies that look interesting in auto and capital goods space. At the right opportunities, I think if you can, we will get into those companies as well. So these are the four themes that we are investing into, and what keeps us going is the kind of opportunities that we see from a growth perspective in these four themes. It's actually ideal for investors who have a very long-term investment horizon, at least 5 years. But if you look at the parallel fund that we run in the PMS, we have seen investors who have come almost 12 years back, have invested and stayed with us for the last 12 years, have seen their money multiplying by almost 8 times compared to the 4-time multiplier impact the Nifty gave. So this is a meaningful wealth creation, and this probably was possible, one, because of our investment philosophy and stock selection, but also because the investors stayed with us over this long period of time. The investment philosophy also intends to invest into mid and small caps as well as the value opportunities, turnaround opportunities. Therefore, for you to really benefit out of investing into this, you have to give enough time horizon for our ideas to play out. So that is the reason why we insist that the investors in this fund should minimum come with a 5-year time horizon, and better is that they stay invested with us as long as possible, because the multiplier impact of doubling your money every 4 to 5 year time period will look a meaningful impact on your wealth if you stay across for 3 to 4 market cycles with us. So this is ideal for investors with a long-term investment horizon, and that's what has worked well for this investment, for this fund also in the past. From an investment philosophy and process point of view is not very different from Atlas 1. Even from a concentrated nature, it's same as what Atlas 1 is intended to do. But in Atlas 2, what we see, given the emerging economic scenario, is the inflation numbers are going to keep coming down really sharp. So in the second half of 2023, it is going to throw a lot of opportunities in the technology space, and given that Europe is still continuing to go through an energy crisis, some of the manufacturing opportunities that we probably could not capture it in the Atlas 1 can be opportunity that we can capture it in Atlas 2. So the theme remains the same. The only difference is that you might see a slightly higher allocation towards some of the domestic technology platforms in India, as well as some of the exporters from India, particularly who have a good market share or have a presence in Europe and other developed markets, as an opportunity to play the Europe outsourcing theme that we think which is slowly evolving. This we think will play out in the next 1 year. So as this fund starts rolling out, I think some of these ideas might get a slightly higher allocation than the Atlas one. So that's the difference. But otherwise, the investment philosophy as well as the investment process is going to be very similar to Atlas one. Thank you.